Hello friends, welcome back. Today we are going to discuss about property, plant and equipment for what we call PPE. So in today's discussion, we are going to discuss about how you have to record the transaction related to property, plant and equipment. Suppose you are working in a company, in a big manufacturing company. The company recently invested 5 million in a high-tech automated assembly line to increase production capacity. So this is an investment, this is a capex investment or capital expenditure. At the end of fiscal year, the CFO asks you to determine how this investment will impact the bottom line over next 5 years. So to answer this, you must decide how do we allocate the cost of this machine over its useful life, and what happens if a newer technology is released next year, making our machine is less valuable. So there are two things you have to decide here. The first thing, how you will impact the cost of this property, plant and equipment or cost of this machinery throughout its life of year, and what will happen if a new technology invented and which will making up this machine, the existing machine, less valuable. So these are some decisions or some thinking you have to do while you are handling with the property, plant and equipment. So to decide this, you have to consider various things to allocate the cost of this machine to over its useful life, what we call as depreciation. So through depreciation, you can allocate the cost of that machine throughout the year where you are going to use that machine. And also property, plant and equipment which is directly impacting your balance sheet, that in the asset side. So it is very crucial, very important to recognize or realize the exact value of the asset which is impacting or which is reflecting the real economic value of that asset. So the core idea, the property, plant and equipment are tangible asset held for use in operation more than one period. So what is property, plant and equipment? These are the tangible assets which is used in operation for more than 1 year. Then let's come to depreciation. Depreciation is a systematic allocation of cost, these assets over their useful life. It's an application of matching principle, pairing the cost of the asset with the revenue it helped to generate. So depreciation means it's the distribution of total machine cost throughout its machine life, and it's also matching the principle, the cost of the asset or cost of the machine has to be reflected in the same period where the revenue is reflecting. Then the impairment of assets. What is impairment of asset? If something happened and your machine lost its value, suppose you purchased a machine for 1 million, then the new technology came and now your machine value dropped to 500,000. So in this case, what you have to do, you have to impair your asset value into 500,000. This process what we called as impairment of asset. When it comes to depreciation, depreciation means you purchased an machinery for 1 million and you assuming that you can use that machinery for next 10 years. So which means that you have to allocate 100,000 to each 10 year if you are using straight line depreciation method. So the depreciation means allocation of the total asset value throughout its useful life, and the impairment means it's the write down the carrying value of the asset due to some specific reasons. Just look into some thinking. If a machine work harder and produce more in its early years, is straight line depreciation truly accurate? What is straight line depreciation method? Straight line depreciation method means you are allocating your machine value throughout its machine life. Suppose you purchased a machine with $100,000 and you are assuming that this machine can be used for next 10 years. So when it comes to straight line depreciation method, you are allocating this 100,000 throughout the 10 years equally. That means 10,000 depreciation will affect for every year. This is straight line depreciation. Suppose in a real business case, if a machine worker harder and produce more in early years, is the straight line depreciation is truly accurate? As per matching principle, it is not accurate. Why? because it is not matching its revenue with the cost. Maybe in the beginning stage, beginning years, you may produce more quantity and generate more revenue, and if you are applying the straight line in the same year, you are applying the same 10,000 in every year. So, this is not accurate and not matching with the matching principle. So, in this case what you have to do, there are other depreciation method like unit of produced method or double declining balance method. These are the some depreciation method you can use in this case. If the market value, let us move into next thinking. If the market value of a building drops significantly, but still plan to use it for 20 years, should we recognize an impairment loss immediately? Again, this is another case. The market price or market value of building drops significantly, but still you are planning to use the same asset for next 20 years. So, in this case, you may not require to impair that asset immediately, because it is not declining any value you are going to receive from that building, because still you are planning to use the same 20 years. So, let us move into details. First one, the depreciation method. Before choosing the depreciation method actually it should reflect the exact business case or economic benefit of that asset. You remember this in mind. So, let us move into depreciation method. The first thing, it is straight line method. Straight line method, as we discussed, equal expense each year. It is normally used for the building and furniture. Suppose you invested 100,000 in a machine or any other asset, you assume that that asset can be used for next 10 years. So, you can depreciate 10,000 for each year. This is straight line depreciation. Now, let us move into double declining balance. Double declining balance is an accelerated method, that means high expense in early years, lower for later years. Suppose you invested in a technologically advanced machines, that means technology, we know that technology will keep changing. So, in this case, you can use double declining balance or accelerated depreciation method. That means you are going to depreciate more value in the beginning stage, and when it comes to the ending stage, the depreciation value will be lower. At the same time, if you assume that if it is in the double declining balance in the same case, that means it is 100,000 your asset value, and you are assuming that you can use it for next 10 years, that means 10% you have to depreciate every year. So, in this case what you have to do, you have to double it, that means you have to depreciate 20% this year, the first year, that means, so in this case it is 20,000 you are going to depreciate in the first year. This is double declining balance. So, in the next year what you will do, you will calculate the net asset value, that means 100,000, then your first year depreciation you can remove from here, then 80,000, this is your balance. So, in the next year what you will do, you will depreciate 20% of this year, this value, this carrying value. So, this is double declining balance, that means you are depreciating double of the carrying value, double of the depreciation with the carrying value. Then the unit of production method. Unit of production method means, it is, suppose we purchased a machine for 100,000 and we are assuming that you can produce 100,000 unit by using this machine. So, if you can produce 100,000 unit, what you can do, based on the actual unit production, you can allocate the depreciation. That means, suppose in the first year we are produced 20,000 pieces, then $20,000 you can allocate as depreciation. This is unit of production method. So, these are the some important depreciation method that normally using. Then the impairment testing. Impairment, what is impairment? We just discussed before. Impairment means if the asset carrying value is lower than its cost, so you have to write down your asset value into the carrying value, in the market value. So, for the impairment you have to do the recoverability test, that means your total undiscounted future cash flow. In this stage you have to compare your total undiscounted future cash flow from that asset from the carrying amount with the carrying amount of that asset. Then you have to compare that carrying amount with the market value. So, these are the two methods you have to consider while doing the impairment test. So, the important thing is the recoverability test. That means what you are expecting, what is your total expected future cash flow from that asset, and you have to compare that future value with the carrying amount. Suppose you are in your books of account, your total asset value is 100,000 and you are doing a recoverability test and you discovered that you can get total future cash flow from that machine is 98,000 only. So, that means you have to consider only 98,000 only as your asset value in the recoverability test. Then in the measurement loss, you have to consider the fair market value with your carrying amount. Suppose in the same machine you are seeing that your fair market value is 95,000 only. So, if this is the case, you have to consider 95,000 only as your net asset value, and the difference you have to impair or difference you have to write off. So, this is the impairment testing for the assets. Let us move into some corporate scenario. Scenario 1, a logistics company buys a fleet of delivery trucks. Because the truck required more maintenance and lost more value in the first 2 years, the finance manager elect to double declining balance method to match the higher utility of truck to the earlier period. So, this is a normal case. If you are buying, if you bought a new truck, so you can choose the double declining balance in the big early stage if you are consuming or if you are using that asset more in the early stages. Let us move in the second scenario. A textile plant on a specialized dyeing machine. New environmental regulation is passed that will ban the chemical used by this machine in 3 years. The finance team must now perform an impairment test because the useful life and future cash flow have been drastically reduced by external factors. Something happen if a technology changed or a regulations change and your asset cannot be used for the initial estimated period. So, what you have to do? You have to do an impairment again based on expected actual future cash flow and useful life. So, in this case what will happen? You have to reduce your useful life. So, obviously your future cash flow will reduce. So, based on that you have to impair the asset value. So, this is a summary what we discussed now, the straight line depreciation method. That means you have to, how you will calculate the depreciation value, your cost, suppose 100,000 is your cost that you can take, plus you are assuming a salvage value. What is salvage value? Salvage value means the remaining asset value after depreciation. Suppose you are assuming that you bought a machine for 100,000, after 10 you can use that machine for next 10 years. And after 10 years, you can sell that machine for 10,000. That 10,000 is your salvage value. So, for the depreciation calculation, you have to reduce the salvage value and you have to divide that by useful life. So, in this case, it is 9,000 will be your depreciation by straight line. So, let us move to next depreciation method. What we discussed, it is double declining balance, and double declining balance mean you have to apply the double of the depreciation method. So, in this case if the same case what you, and also in the double declining balance you have to ignore the salvage value. If you are using, please remember this, if you are using double declining balance, you do not want to consider the salvage value in the double declining balance, double declining depreciation method. So, in the double declining balance how you are going to calculate the depreciation. So, in the same case it is 100,000 and your normal depreciation based on the useful life is 10%. So, you have to apply 20% in this case and 20,000 is your depreciation value in the first year. In the next year what you will do, you have to see your net asset value. So, in the next year your asset value will be 80,000 only, then you have to apply another 20%, that means 16,000. So, in this case what will happen, in the early periods you will apply more depreciation than later stage. Then the impairment loss what mean, if your asset carrying amount is more than your fair value, then you have to impair, you have to do an impairment test for your asset and you have to convert your asset value into fair value. So, here are the some important things you have to consider while attending the exam. The first one is salvage trap. In the double declining balance, do not apply salvage value. It is very important. In the double declining balance method, you do not want to apply, you do not need to apply salvage value. The recoverability rule. For the test, use undiscounted cash flow. For the measurement loss, use fair value. So, in the recoverability rule or in the impairment stage, for the recoverability rule, you have to use only undiscounted cash flow only. Again, for the measurement rule of loss, you have to use fair value. Again, another important thing, land value is never depreciated. So, if you are considering depreciation for a bundle of asset like land and building, you have to remove the land value while considering the depreciation. So, just a quick summary what we discussed now. The depreciation is about allocation of cost to its useful life of asset. Again, we are allocating depreciation to in align with the matching principle in accounting. That means the revenue has to be matched with our cost has to be applied in the same period where you are generating that revenue. Then the straight line in depreciation, which provide early stability in earning, because you are going to apply the same depreciation in almost every year, and the double declining balance, that means you are applying more depreciation in the early stage, so which will give a tax benefit in the early stage of business. Again, the impairment of asset is a one-way street for asset held for use. That means if your asset carrying value or the expected future cash flow is less than your carrying value, you have to write off your asset into that process what we call as impairment value, impairment process. Again, if you return off one time, there is no reversal or return back under US GAAP. Again, always check the profitability test before calculating, recoverability test before calculating an impairment loss. You have to do a recoverability rule before calculating impairment loss. That means for the recoverability rule, you have to compare the undiscounted expected cash flow from the asset and the fair market value of the asset with the asset carrying value. So, let us move into multiple choice question practice. A company purchased an equipment for 120,000 with a residual value of 20,000 and a 5 years useful. Using double declining balance method, what is the depreciation expense for year 2? Option A 28,800, option B 48,000, option C 24,000 and option D 19,200. So, it is the double declining balance method. So, the total purchase value is 120,000, and one thing you have to remember that you do not want to consider the residual value in the double declining balance or salvage value in the double declining balance. So, 120,000, first thing you have to calculate the value for depreciation value for the first year. So, it is 5 years useful life, that means you have to apply 20% in every year. So, when it comes to double declining balance, you have to apply the double 40%. So, 120,000 into 40%. So, in the double declining balance, what you have to do, you have to consider double of depreciation than straight line depreciation. So, that means the first year it is, so it is the useful life year is 20%, 5 years, that means 20% of asset has to be depreciated as per straight line depreciation. So, when it comes to double declining balance, it is double of this, that means 40% of your carrying value has to be depreciated every year. So, as a first year depreciation, it is 120,000 into 40%, that means you have to depreciate 48,000 in the first year. This is your first year depreciation, that is 48,000. So, for the second year, what is your carrying value? It is 120 minus 48. The 72,000 is your carrying value for the second year. So, how you will calculate the depreciation for second year? That means you have to apply another 40% of this carrying value, which is, so here is 72,000, you have to apply another 40%, which means it is 28,800. So, here the answer is option A. So, this is the way you have to calculate the depreciation as per the double declining balance. That means you have to, first thing you have to remember, you do not want to apply the salvage value in the double declining balance, and the second thing you have to apply the double of straight line depreciation method in percentage, and for the next years you have to consider the carrying value of the asset or the net asset value only for the calculation. So, let us move into question number 2. An asset has carrying amount of 700,000 and expected future undiscounted cash flow from asset is 650,000 and the fair value of asset is 600,000. Under US GAAP, what is the amount of impairment loss should be reported? Option 1 0, option B 50,000, option C 100,000 and option D 700,000. So, here what it is asking, it is the impairment loss should be reported, what amount of impairment loss has to be reported in this period. So, here the asset carrying value, first you have to do the, you have to compare the carrying amount with the undiscounted cash flow. So, here 50,000 is the gap or is the difference, and you can, the second thing you have to compare the carrying value with the fair market value of asset, that is 600,000. So, there is a 100,000 gap when you are comparing the carrying amount with the fair value of the asset. So, this 100,000 you have to consider as impairment loss for this period. So, this is about today's discussion. What we discussed is about property, plant and equipment. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.